Hi, everybody. Barry McGuire here for Barry McGuire's Creative Real Estate Education Series. We meet up every Monday, the Monday main event, and we talk about all things creative real estate. We like to bring in folks to help us, appraisers and mortgage brokers and accountants and developers and all kinds of folks to tell us about various aspects of creative real estate investing, so that we can improve what we do. My wife Donna and I also put on what we call focus workshops. Those are 1 day and 2 day live events where we talk about creative real estate strategies like rent to own and agreements for sale and joint ventures and options and fix and flip and wholesaling. We spend a whole day or 2 days, depending, just diving deeply into those things, all the documents, examples, experts, to supercharge where you want to be in creative real estate. So we've done 3 of those this year so far. We did wholesaling in Calgary. I think that was in March. And then AFS, agreements for sale in Toronto. Very successful. We have lawyers down there who are realizing what an agreement for sale is. And that's very important because you need lawyers who understand the strategy. And then we did what our famous Rapid Cash program. That's a 2-day event. And that was May 27th, 28th here in Edmonton, where we go over all the strategy. So that's what we do. And today we are totally delighted to have on some folks from Calvert. Calvert Mortgage Investment Corporation, Home Mortgage Investment Corporation. We've got, there's Crystal. Hello from Red Deer. Hi, Crystal. So Donna's going to bring in Ryan Day and Sherwin Dziwenka, who are... Dziwenka. I'm sorry, Sherwin.
That's all right.
Tough on your name there.
It's alphabet.
My producer here will keep me on the straight and narrow. Both these folks work for Calvert. Sherwin, you're a senior underwriter. Ryan, you're I don't want to call you a junior. I mean, that's fair.
Just business development.
Business development. Okay, there we go. So happy to have you guys on. For people who don't know you, let's start off with just a quick kind of resume about who you are and what you did in your earlier business life before you landed at Calvert. Ryan, let's start with you, and then we'll move over to Sherwin.
Yeah, for sure. So yeah, thank you first and foremost for having us on. Really appreciate taking time out of your busy day and having us on. We're really grateful for the opportunity. So my name is Ryan Day. Been with Calvert for, I guess, 2.5 years. My background's on sales. So started out working at Coca-Cola, Heineken, Molson Coors. Wanted to get into real estate. I thought there's no better company than to work for an established private lender who specializes on helping serve real estate investors here in Alberta and Ontario. So reached out to a mutual connection. He introduced me to Jesse, our vice president. We hit it off, and it's been history ever since.
Well, I know that Calvert is growing. I mean, haven't been in Ontario for that long, but the book of business is building, and that's your part of it, to build the book and help Calvert grow, I guess. And it seems like you're doing a good job because they're definitely growing. Let's move over to Sherwin. Sherwin, you have been at Calvert for longer than that, but where did you start out before you were at Calvert? And give us some of that.
Yeah, so I came from the mortgage broker industry. I was there briefly, only for a couple of years. Prior to that, non-related to the real estate industry in any way. I was a lab tech once upon a time and worked as a manager in different roles and stuff like that. So took a big jump, changed my career path and became a mortgage broker, and then didn't quite fit on that side of things. And the lender side of things was a lot better for me, and found Calvert about 9 years ago now, just over 9 years.
Oh.
So as a senior goes well with the senior over here. So been underwriting, seen a lot of different things, and definitely Ryan has helped escalate our business when we went to Ontario and we really ramped up. When I started working with Calvert, we were 7 employees. Now we're 44, I think. Mm-hmm. That number might be a little bit off, but we're around there. So significant growth, even from I believe we were 30 million deep, and now we're 300 plus million a book of business. So definitely a lot of growth.
A lot of growth there.
Yeah.
So we're going to, at the beginning of the show here, talk just a little bit more about Calvert. You've set that up nicely. And then as we get to the end, I want to make sure people know how to reach you guys in order to help. Donna, what are you pointing to? Okay. Donna's already got it there. So we're going to know how to reach you guys. So now you've given some stats there. When you joined, Calvert had a book of business, $30 million. So that means you had $30 million worth of mortgages out there.
Right.
And now you have $300 million dollars worth of mortgages out there, and you are growing. But Calvert's been around for a long time in the space that you work in. I think you're one of the more senior companies, if I'm not wrong. Is that right? You're
right. Calvert started in 75, so we're close to 50 years young.
Mm-hmm.
We started as a mortgage brokerage, and then became a MIC in the early 80s. So we've been doing this for a long time for sure. And really, our focus is not much different than it was back in the day, where there was an opportunity with flippers and short-term type of investing. It's just morphed a little bit to kind of be in line with offerings of other private lenders. So we do other things, but again, we still focus on our flip and burr products. That's the number one deal that we do right now.
Okay. All right. Well, I think it's important for people to hear. I mean, there are lots of mortgage investment corporates, lots of MICs out there, as they're known. There's lots of MICs. You can give your money to many different companies, and so apart from what you're going to tell us, I mean, this is all background for people who are maybe thinking of putting some money with Calvert instead of borrowing money from Calvert, and just letting them get to know the company a little bit more. Ryan, I want to move over to you on that point. So you're a business development guy. So you're looking for somebody like, say me. I've got, a couple $100,000 I want to invest. And is it someone like you I would talk to so that you can tell me about Calvert and how it works? And is that your
for sure. There's definitely 4 people on the team who are licensed in order to raise capital. So it'd be myself, Garrett Labar, Jesse Bobrowski, and Dean, our president. So we are an exempt market dealer. So we're an exempt market product. So with that, there's specific criteria that we're only able to accept capital from permitted clients and accredited investors. Happy to dive into that on this conversation. But if you are looking for something a little bit more hands off, we are looking to raise a little bit of capital in the short term. We also have a credit facility from BMO, ATB, and Canadian Western Bank. So we borrow debt from a few of the big banks, and we lend out that capital short term as well too. And obviously, the primary benefit of having a credit facility is just cheaper debt.
Yeah.
So if we're able to borrow at prime plus 0.5, it significantly helps with our fund and our return on investment versus raising capital through new shareholders.
So that where I'm trying to get to with this, as we move a little farther into what exactly you do when you make a loan, is that I want people to know that Calvert is an experienced lender, and I want you to. I mean, you're in sales essentially. You're looking to raise capital. That's sales, which is what you've always done. You must be good at it. So when you're talking to people about whether they want to put money with Calvert, why do you explain to people why Calvert is a good spot to put your money when there are lots of other choices?
Yeah, for sure. It definitely comes down to a good fit. So we are a very illiquid investment when it comes to investing in Calvert. We're only able to accept redemptions. So if you're investing in Calvert, you are pretty much stuck with us for a year at a time. Definitely more of a passive investment. What I think really stands out first and foremost is just the returns that the company has had. We've never had a negative return in over the past 40 plus years. But it really has to fit their risk tolerance as well too. Just because we are an exempt market product, we are considered high risk.
Sure.
In that space. There's also requirements outside of that as well too. In terms of concentration, we typically don't allow investors to invest up to 10% of their net worth in Calvert just due to concentration risk.
Yeah.
And returns are available on an annual basis depending on which product that you invest in. So we have debentures, which is investing in debt, and then equity. In terms of preferred shares, redemptions, similar to distributions, are paid out on May 10th of every year. When I put my shareholder hat on, there's definitely a few things to look at when it comes to diversification in terms of mortgage product, geographic location, obviously understanding the loan to value of the portfolio as well too. Our current loan to value of our portfolio is 59%, so relatively low loan to value in terms of the industry average. There's also a few other things to note is when we do borrow from a credit facility, they're doing due diligence on us on a monthly basis. So in terms of risk and having a third party or a third set of eyes review and essentially do due diligence on you as a shareholder, that's something that obviously the more people that you have looking into your book from a trustworthy credit point of view,
Sure.
Really understanding, what's on the book and what's behind the book and the risk associated with.
So you're actually a conservative place for people to money. Yes, there's risk, and yes. But in the space, you have a pretty conservative approach that served Calvert well over the years. I mean, no negative returns is over all those years. I don't think there's many companies can say that they haven't had a negative year. So I just wanted people to hear that a little bit because it's important for them to know if they're ever considering going with Calvert. But now I'd like to move a little bit more into the diligence side of things. This series that we've been doing is on private lending, and Calvert is not in. And true private lending is, I'm lending you $50,000. That's a private loan, just personal between us. But it's private lending of a sort. It's certainly alternative lending. It's someplace for people who need money to come and talk. And so, there's a lot of confusion for people who don't know how to lend, which is the process as you guys describe it. You underwrite a loan. When somebody comes in and says, I want money, sure, when you look at it, you are underwriting the loan. People don't know a heck of a lot about lending. Actually, it's usually, when it's person to person, it's handshake deals and not a whole bunch of diligence being done. But let's get into at least the basic kind of diligence that you do when someone shows up on Calvert's door and wants a loan. I know it's way more complicated than we have time for today, but give us the kind of summary, if you can, of the sort of diligence that you do for a mortgage applicant with Calvert.
Yeah, great question. And you're right. We can go on and on about it, but there's some real basic things that we're looking for. One of the things that obviously we want to see is your application. What's your net worth? What do you have for assets? What kind of liabilities do you have? Can you service your liabilities? And now, because you're asking for another loan, can you service that new loan in addition to what you currently have? So that's one of the things. That's more important in certain deal types than others. And when I say that, I mean, like flips and burrs we usually have a really quick exit, so that there's a defined, we're going to renovate for 3 months, then we're going to sell, or we're going to renovate for 3 months, and then we're going to refinance. So there's a defined there. So we want to make sure that you have the ability, instead of carrying it long-term, just to get through that project until your exit is there. So again, we look at different deals a little bit differently, but it's still with the mindset of the affordability of what we're putting out. Second is historically, how well have you made your payments? The credit bureau obviously gives us a lot of information with respect to that. Equifax has so many different creditors reporting into them. So we get a really good sense of your ability to make your payments and stick to them by that. So that's another thing we'll look at. We do have some limitations on credit scores, but we do have the ability also to make exceptions. Obviously, the higher the credit score, the better for us, the easier to do the loan. Thirdly, obligations to CRA and other obligations, like, want to make sure that there's certain CRA taxes that actually can supersede us on title. Really important that we work through that and make sure that we're not setting ourselves up for failure by missing something that actually can be in front of us on title. So a couple of those they're all from the Excise Tax Act. So they're the GST, HST, the employee source deductions, and then the third one. Why am I drawing a blank right now? Employee source deductions, GST, HST, and I'll think of it. Anyways, the first two are the main ones that could come into play, especially if you're borrowing as a corporate borrower. We do allow corporate borrowing, but sometimes the corporation is an operating company, might owe GST. So we'll want to make sure that we deal with that in one way, shape, or form. You have employees, same way. We want to make sure that that's dealt with. You can be a sole proprietor as well. I mean, and you might need to charge GST as a sole proprietor. So even if you're a personal borrower, you can still have a GST owing. So we want to work through that. Those are the high level personal stuff. And then we get into more of the security. Like what is the security all about? If it's a flip or BRRRR, obviously there's a renovation plan. So we're going to take a look at what does the property currently look like? What are you doing to it? We're going to take a look at that end value and see, does this deal make sense? For a flip, is there a good profit margin that makes sense for you to proceed? For a BRRRR, does the end product allow you to refinance and cash flow on this property? So one of the biggest due diligence in those products for us is your success as a borrower. Our biggest filter in those is profitability or successful projects. So if we don't see that, we won't do the deal. Mostly because, and there's a little bit of us being wanting to make sure on our side that there's the ability to get through and you're successful, but we want to be a long-term partner. So if you go out and do a deal and we support a deal that we know is not going to make any money and you're going to lose money on that first one, what's the chances of you doing another one, right?
Yeah, for sure.
So that's part of our due diligence as well. And then just funds to do projects. Again, if it's in those flip or BRRRRs, we want to make sure you have the ability monetarily to support the project and get through it and do the renos and so on. So I think that's pretty all it. Somebody said condo fees. I think that's what they were referring to, superseding us on title. That and property taxes definitely do. So we want to make sure those are taken care of as well. They're a little different because they're part of the property versus part of your personal taxes. But they are important that we work through that as well.
There. Now, when you were talking about the examining the security and the borrower's success, were you meaning that I appreciate that the project itself, if it's a flip or a BRRRR, you have to look at what's the examination around whether this fix and flip can be done and actually resold and make some money, or if the BRRRR, the renovation can be finished and refinanced. You have to look at those margins to see whether it makes sense from that point of view. But what if the person applying has no experience? Is it they're doing their first deal? Is that different for you than if they're coming back to do deal number 3 and they've always done what they said they were going to do?
Yeah, as soon as I finished, I realized I missed a really important part of flips and BRRRRs is your ability to execute on the renovations and whatnot.
Right.
So we definitely will. That'll be a part of our due diligence. Some people will use external contractors, and that's okay. We hope that and want them to have experience with those contractors so that they know that they themselves can execute, especially in a timely manner. Time is always money, so you want to be able to make sure that your project's moving forward. Personally, definitely, it's a lot easier for us to do the second, the third, the fourth deal because we've seen execution, we've seen your ability to do that. Sometimes it's not with us, but you've done previous projects elsewhere, and we can see that and give us a good sense of your ability again to execute. But what does it look like when you're finished with a property? You know, like, and it gives us that sense of, okay, here's their level of renovations. And, so we can use that to help us do our valuations. The other thing too is we underwrite the personal side of things once a year, usually on deals. So if we have a flipper doing, 5, 6, 10 projects in a year, we underwrite, we do the application bureau, that kind of stuff once a year. And all we're looking at is just the upcoming project, for new deals. So it helps with speed, for one. We can give you an answer quick because we're just looking at the project itself, which also allows us to close faster. Yeah. But it also, gives the ability for clients to be able to do maybe do multiple projects at once. Sure. So when we're looking at one project and another one comes up, and then we're gonna see where they are in that project, see how it's moving along. Okay, yeah, you're almost going to be done that one when this one closes. Okay, yeah, you have enough funds to finish that one and take this one on. So we're sussing that whole process out and making sure that, again, they're setting themselves up for success, and they're not going to be, you take on 3 properties and wow, I don't have anybody to do any of the work. Sure. Those kind of questions, right? So that is definitely a big part of it for sure, Barry.
All right, so that I didn't know about the underwriting one. So when somebody starts out with you, you do a deep dive underwriting on them and the project at hand, and then if in the next year, if they come along with other projects, you piggyback on the initial deep dive underwriting, and then work the current project numbers and issues into your original underwriting. But then when one full year has passed, you then kind of redo the deep dive to make sure that what you had back a year ago is still valid. Am I understanding?
Yeah, that's it. I mean, like NOAs only happen once a year. Financial statements happen once a year. So it's kind of in line with that. Credit reports don't change a lot in a given time period unless something drastic has happened. Sure. We're not going to be able to control that a lot, especially, it's kind of funny, but we'll often see clients, execute like very well at flip and burr projects, especially flips, and their credit might dip a little bit next year. And then you have that conversation, you speak to them about that. Often when brokers are involved as well, though, brokers are already working with them on that. So we will look at deals from either directly or with a broker involved. So it just depends on the scenario. We can give some credit score increase advice, or, the broker can do that as well. So, again, things don't change a lot with our clients that do multiple projects. At least my experience. I mean, like I said, I've been here for 9 years. I've had a lot of clients do repeat deals. You retake their application, their bureau. The only thing that changed on their application is usually they have a deeper, real estate portfolio. Sure. Their credit, probably stayed the same. Their income probably stayed the same because a lot of them are salary jobs on the side, and they're doing or one or the other, right? So things don't change a lot. So that's why, once we do that deep dive and we're comfortable, and then we see you execute, that's why we don't go back to that every time.
Okay, I understand that. Now, Ryan, when you're talking to folks who might want to invest, do you tell them about the kinds of things that you invest in and why you like some kinds of investments better than others at Calvert? Do you work that into how you explain what Calvert does?
Yeah, for sure, definitely. Yeah, just I could definitely give some bullet point notes. Like 98% of our portfolio is first mortgages. The other 2% is second mortgages. It's primarily residential real estate on the lower end to mid-market price points. And the reason why we typically focus on that is because from our experience, there's always a floor to how much prices can drop. Typically high-end luxury homes, whenever there's a decrease in the market, those are the most susceptible to the largest decreases in prices dropping. So that's the main reason why we focus on those specific asset classes. And then we're primarily lending in major urban city centers. So primarily populations 100,000 and above. The reason for that is just more demand for properties in major urban city centers versus rural, populations below 10,000. So we'd like to think we're quite secure in that sense, focusing on, the property types that turn the most in major urban city centers that are the least, not obviously, nothing's guaranteed, but the least susceptible to risk of having a major price decrease.
Sure.
And then I think the history definitely holds a lot of weight. Like we've lent out 1.4 billion in mortgages over the last 45 years. That's spread over 8,000 loans. Our loss ratio was 0.3%, so relatively low as well too for the industry average as well too. So
Ryan, what is the industry average? 0.3 of 1%, is that right?
Correct. And around 1%.
Wow. And the industry average is 1%. So you're 3 times better than the industry average, roughly.
Yeah. And the main reason for that is just having the short-term focus. So our portfolio has a lot of velocity just because the average payout happens in around 6 to 9-ish months. Because we're serving real estate investors, 8% of our portfolio pays out on a monthly basis. So other lenders who typically lend out for 1-2 years at a time, private lenders, on the borrower side, unfortunately, they have those pesky lender fees and commitment fees. So from an investor or shareholder point of view, if you're able to turn your capital out twice in 1 year, then we just have higher velocity of our capital. It works in favor for our borrowers. They just want a fully open mortgage, be in and out as quick as possible. So it's very beneficial from the borrower's point of view and from the shareholder's point of view, having a product that meets the needs of both ends of the spectrum there.
Yeah, those are important things, and we've heard about that on other parts of this series that we've been doing. Being in the luxury side of the market where there's a chance for big price fluctuations is dangerous for a lender, especially an inexperienced lender. You guys are an experienced lender, and you don't want to be in that space. And then as well, being in a larger population center. I think you said 100,000 is sort of your limit, like a place. Or did you say?
Yeah, populations 100,000 and above.
Yeah.
The primary focus of.
Yeah. So that means you don't do any rural loans. That's just not anything you guys do because obviously it's not in a population center of 100,000 or above, and it's a dangerous loan to do, too unique, too hard to foreclose, too small a market. So you stay away from rural stuff completely?
Stay away from rural. The rule of thumb that we have is a minimum population of 10,000 and above, but I can let Sherwin speak to that as well too.
Okay.
Yeah. Sorry, I'll just kind of clarify some of that. So we will look at centers as low as 10,000 above. I think Ryan was kind of alluding to the fact that most of our deals fall in that 100,000 or above. So that's kind of our sweet spot. And then at market average. So the other thing I wanted to say about when you talked about your 3 times better, one of the things that the Calvert is very different from other private lenders is there are pure equity lenders out there that their due diligence on the personal side of things isn't as high as Calvert's would be. Calvert is very borrower focused, meaning we want to ensure that the client, we're a stepping stone, and they have the ability to succeed. Either, again, if it's a flip or burr, those are the easy exits. But sometimes we do a debt consolidation, and sometimes those are tough. But what is the means to the end? Like, if we do this and you do this, and this, will you be able to get a refinance done at a B lender or an A lender, right? Yeah. So we underwrite more than just the property itself. So I think that's where, when we're talking about the private industry, why we're significantly lower than the average with respect to arrears and foreclosure kind of deals. Yeah. And it's really important to us for the success of our clients. I personally hate foreclosing, just so I avoid it at all costs. I do not want to go there. So it's really important. One last thing I'll say to investing, all of us underwriters are shareholders ourselves. So we want to do the best, obviously, for the company and the return. So that's in our best interest to be able to ensure that our money doesn't go the wrong places. So my mentality, and I believe we all have the same mentality, is, lend it out like it's your own money kind of idea, because you want it back. So that's the thing that, some of us that have been here longer have that mentality, and even the newer people that are starting to underwrite their own deals, they ensure that, we are setting clients up for success, and we're not putting any of the money that's going out the door at risk, at too high of a risk.
That's even on that point as well, too. I was just going to say, just having a lot of the expertise in-house as well. I don't know if it was mentioned, but we have 4 appraisers in-house as well, too. So we'd like to think we have a really good pulse on the market. If we ever need an updated valuation for our portfolio, we have the resources in-house where we're able to do that. As long as we have property photos, we're able to do a valuation as is or as complete, and really understand and flag, if the HPI is dropping in a specific community in a specific city, communicate it out to the team, and make adjustments as we see fit.
I see the monthly reports that get sent to me, where you analyze the market. So they talk about keeping a pulse on the market. Inside you've got your 4 appraisers, but you're also, looks like, gathering and consolidating all that information and reporting to shareholders on what's going on in the Alberta and Ontario markets on a monthly basis. So that's important to know. Now, I had a thought there. What was my thought? Oh, yes. Sherwin, you said something, that there are lots of lenders out there that are pure equity investors. And just tell me if what you mean by that is, if I'm a lender and somebody comes along and wants to borrow from me, my in-house rule of thumb will be, if you've got 50% equity in your house, I'll lend you up to 30% of that equity. I don't care whether you have a job or don't have a job, or what your payment history is. I don't care about anything, as long as you've got equity and you can prove it. Is that what you mean, a pure equity lender?
Yeah, I mean, I don't know. I hear it all the time, maybe because of the station I listen to on the radio, but you hear, if you own your house, we'll lend to you, basically. Yeah. That's really what that's all about. It's all about the security and making sure the loan to value protects your money out the door, and that's what they key on, versus the ability to make the payments and to succeed down the road. Not to say that those don't succeed. I'm just saying that it's a different mentality, and we underwrite probably a little bit differently than pure equity lenders.
Yeah, no, I agree. Well, I mean, it's such a better business model to be lending to people with the goal of creating a long-term relationship, where they're happy and they'll recommend you to other people, and business builds like that. Yep. I mean, I don't think you can ever go wrong in business if your model is to help people and not beat them up. You're looking for the win-win in any situation. Of course, you have to do well for your company, but on the other hand, you're not going to do well for your company long term what you do for the borrowing client doesn't set them up for success. And win-win is obviously how you guys are looking at it, and it's had great success for you with the way the company has grown.
Yeah.
All right, so now Donna put a note in front of me. She says, Donna, is your question, do they do diligence on the investor or the property deal?
Is there a balance of what the focus goes on for what you're analyzing?
Right. So Donna's wondering about whether there's a balance on how you underwrite the investor on the personal side and the specifics of the property deal. Is there, do you kind of weigh one more than the other, or how do you balance those two pictures out when you're looking to lend some money?
So less like when you say investor, you really mean the client, the borrower.
The borrower, yes. The borrower.
Okay. Yeah. So that is very deal type dependent. When you look at a flip or a BRRRR, the property and the project itself is really important. So meaning I want to make sure that, yes, there is, if you want to call it some meat on the bone, there's some profitability there. Now, obviously the other side of the due diligence that we talked about was your ability to execute. So can you do the renovations, or do you have a team that can? And then the funds to get through. So the funds to get through are easy because it's a piece of paper. Hey, here's my bank statement. I got the funds. The ability to execute is often, like you suggested earlier, Barry, was, hey, look, I've done these 3 flip projects before. So often that's pretty easy. And you can often really tell a lot about people by the rental plan they send in. So when we're analyzing these types of deals, we ask for them to provide us a detailed rental plan, a budget, and a timeline. And when you see the rental plan with the budget, with the timeline all together, you can see who's a seasoned flipper, renovator, and who might be fairly new, just the way they write up their plan. So often that side of things is really easy, and then it's just project driven. It's the property. It's how cheap are you getting it for? What do you got to do to make that profit? How long to execute? That kind of stuff.
Okay.
The BRRRR deal's a little bit different because BRRRR requires you to have the ability to refinance at the end, right?
Yes.
So we're going to look at you a little bit differently because we want to make sure that there is a lender out there at the end of this project that's going to take on you as a borrower from them. So again, a little bit more on the personal due diligence. Now, if we're talking about other types of deals where it might be a longer term type of mortgage, the person itself is going to be just as important, or maybe even more important than the property. The property is going to be, I'm going to do it at a certain loan to value. I'm going to do the valuation. Here's what I can offer you. That's done. Now, can you afford your payments? Can you service this debt and the debts that you have? And can you stick with a plan that gets you to be able to refinance and your exit down the road? So again, it's the deal type that really gets me, which way I focus my underwriting on.
Okay.
You're welcome, Donna.
So, folks, if you're listening to this and you want to listen again and go over a few things, I really want you to focus on this last chunk that Sherwin was talking about, how he looks at a flip project slightly differently than a BRRRR, which is again slightly different than a longer term mortgage. There's different things to emphasize, and Donna wanted to know, where's the balance when you're looking at the borrower versus the property, and the balance changes depending on the project. I think is the project and the circumstance and the person in front of you. It's there's a lot of factors that go into this, Sherwin. My goodness, as we talk about it.
Yeah, we decided that having the knowledge in our brains wasn't enough, so we decided to put it in a lending standard most recently. Mm-hmm. And we have this Bible. I think it's around 60 pages of just, this is what you do here, that kind of thing. So yeah, there's a lot to consider. Different property types, condo versus single family detached versus multifamily. There's just different factors in each one of them. So yeah, it's very very deal dependent, I guess I'll say it that way.
It's deal dependent, and there are lots of factors. And when we started out our series on private lending, we really were just talking about folks who were going to lend personally, one person to the other person. And I know from, being a real estate focused lawyer and seeing the disaster that can befall people when they make those kinds of person to person private loans. I mean, it's why I wanted to have you on and have people hear about the depth of diligence that is done when people are doing this, like you guys are, as a living for a company that does it as a business. So it's, lend as if it was your own money. I want lots of those folks who are going to lend money to their friend or their neighbor, to lend on that basis, and that they do want to get it back. So let's talk a little bit about how you set your rates on your loan. I get that question a lot. Somebody wants to borrow, I'm prepared to lend. How much should I charge them? And I go, that's not my end of it. It's hard for me to say how much people should charge, but how do you work that into what Calvert does? Interest rates go up and down. How do you do that?
That's a great question. And I know some of the people that are on the call that I've seen come on, would have experienced this from us, where the Bank of Canada keeps on doing crazy stuff and raising rates. And we all know why, and it makes sense. But it costs us as a lender an increase as well. We have shareholders, definitely, but we also have a line of credit that we borrow against to be able to service all of our outgoing money. So as the Bank of Canada rate increases, our borrowing rate increases, and we've done really well with respect to not putting the entire increase back on the borrower. We were able to not increase the full. I think it's at 4.25 now, or 4.25. So we haven't put that full increase. I believe our rates have increased to the tune of about 2.75. We never raised on the most recent one. We decided to stay status quo. A lot of it has to do with being competitive. Obviously, you can't have a product and put you can't sell the same shoes at twice the price, right? So,
Right.
so you got to be competitive in the market, for one, but you also have to price for risk, which is another. So, for example, if you look at our Flip and Burr product, it's really based on how much are you going to put down to mitigate our risk, and then we can give you a better rate based on that. So our Flip and Burrs are really defined by how much you put down on purchase price. Obviously, there's upside on the ARV, the after repaired value, when you do your renovations. So it makes it even better for us on long term. But the risk happens on day one when we close with you. And in Alberta, we can do it with as little as $10,000 down. Our risk is really high. When you add in fees, you add in legal fees, you add in all this stuff, we're really close to 100% loan to value on day one. So risk high, that equates to a higher rate.
Sure.
It doesn't necessarily mean the end of the world, because you can still do deals with that little down payment, because there's enough room that you can pay your interest, get them done quickly, and still make profit on those deals.
Yeah.
So that kind of mortgage is really designed for people that don't have the full amount to put a big down payment and do the rentals all together. So we allow them to put a little less down up front and keep their money to get those rentals done, carry the mortgage, get it sold, and make their profit. Also allows people that want to do multiple projects at once. Because if you go and put 25, 30% down on one project, then got to do renos that might cost $100,000. Sometimes you might have $300,000-$400,000 into one project. I don't know a lot of people that have that to do multiple projects with, right?
No, not at all.
Yeah, so this allows you to maybe do multiple projects with a little bit of down, keep your money to do those renovations and churn them and make profit on multiple projects.
Yeah.
So just depends on your given situation. But then we have a lot of investors that put the 25% down. And at 25% down, that's our best rate. Anything after that, we're going to be at the same rate for flips and burr product, right? Because our risk is very mitigated. We're at 25% down on day one. They're going to improve it, so we're going to even get better over time. So we know that we can offer our best rates there. So that's how they're dictated with that product. With respect to other products, again, they're really risk related. It has to do with loan to values. It has to do with exit strategies. How long do you need us? Those kind of things. So again, lots of factors go into dictating where our rates are going to end up.
All right. So let's say you're dealing with with an investor who has a couple of borrowers who have the same level of experience. They've done 3 or 4 flips or burrs each. They've done well. They've pretty much done what they say they're going to do, and you have confidence in them, especially on the experiential side. And now they're both coming to you for another loan, similar to what they've done before. One of them's putting down 25%, and one of them is wanting the $10,000 deal. What's roughly the interest rate gap between those 2 loans? Is it 2 or 3 or 4%?
A little bit steeper than that.
Yeah, let's do the math. I mean, it's almost double.
Yeah.
Almost, oh, wow.
Yeah, it's
Holy
significant.
It's
Our
10%.
rates,
Yeah.
our rates right now are 999 on 25% down, interest only, fully open type of mortgage. At $10,000 down, our rate is 18.24.
There you go.
It's a significant difference. And the biggest jump, I think, comes when you get to 15% down. It's somewhere in that range. I can't remember off the top of my head, but it's either from 10 to 15% down or something like that, because that's kind of our sweet spot where we feel comfortable, where we're gonna, where our risk is very mitigated when we have that at least 15% down.
Yeah. Okay. All right. And for folks who haven't borrowed at this level before, I know you guys have sophisticated spreadsheets and programs. I'm sure you're able to help newer borrowers who haven't done this before. You can sit them down and look at what they're doing and say, we may be charging you a rate somewhere between 9.99 and 18.24, but here's how those numbers fit together. This is why what you've brought to us and what you've told us leads you to a nice profit down the road. And that's why we're a good company are you able to explain and show people how all those numbers fit together?
Yeah, you alluded to our spreadsheet, what we call our flip analyzer. It's
right.
Just a glorified spreadsheet, Excel spreadsheet, but it really contemplates all your costs in a certain project. So it allows you to punch in all of your numbers and basically see your profitability. It also allows you to play around with the numbers and say, ooh, if this was my purchase price, here's my profit. So that's really what I want to focus on is I want to get a profit of at least this much. I need my purchase price to be this. Yeah. So bottom line, when I underwrite, when I talk to people, I say any property can be a great flip deal. Bottom line, it's all about the purchase price. Yes. So if you can get it at the right purchase price, you can make money on any property out there. There's no doubt about that. So contemplating that ahead of time and making sure that you know where you need to cap out and tap out, you're done. No more increases in my offer. That's really valuable to be able to punch those numbers into the spreadsheet. The other thing that I will tell you about, and I didn't say this a lot, or didn't talk to a lot about, but Ryan spoke to it a bit, is we have in-house valuators. So they're actually all appraisers that work directly for Calvert, and we will take a look at your property and we will determine the after repaired value internally. We've had, I don't know how many conversations I've had in my time at Calvert about, why a property might not be the best for a flip. What market factors are out there that might inhibit you from selling this quickly? What competition are you up against? Like, look at the inventory. There's 6 months of inventory with the same product that you're putting out there. So you got to be really aggressive on price, when you list it. Other things like, are you in a market that, you're putting in lino and laminate when you really need to be putting in hardwood and marble? So we're analyzing the community that you're renovating in and making sure that you're fitting into that community. I always say, don't be the biggest house on the block and don't be the smallest house on the block. Be in the middle, because most of the time people are moving to that community because they want to be in that middle. They want to be in the average of that community, right?
Yeah.
So that's really important to us. And we want to provide that to our new borrowers that come to us. And we want to ensure that they understand that we're another set of eyes on that end value. And we're going to give you feedback such as that, like with respect to inventory, like with respect to you're doing these high-end renovations, but did you realize there's a bus stop right outside your front door? That kind of thing. Those two aren't adding up, because this isn't going to be a forever home for people when they have to listen to the bus stop outside their front, that kind of stuff. So just little things like that, but it really adds to our feedback to the clients.
Well, I'm listening to you say that, Sherwin. I'm thinking this is the dose of reality that you get when you come and talk to Calvert and want to borrow some money, and run into your flotilla of experts who will quite nicely but firmly go through all of the many factors that we talked about and say, you're trying to renovate a 700 square foot house in a neighborhood of 2,000 square foot houses that it can't take it. It's by a bus stop. I mean, there's so many factors that go in, but people have to hear the reality, and I'm pretty sure you can tell them that in a nice way, but get the point across because you've done it a few times.
Yeah, here's my negative pitch. I'm a mortgage broker, a licensed mortgage broker. I'm also a licensed realtor, and so I don't want to speak badly to realtors. If you're working with a good realtor, that's awesome, because they're going to guide you the right way. Every once in a while, we'll get a deal with a realtor that's leading our borrower kind of, I don't know, like the pie in the sky number as the after repaired value. That's
right.
Really not correct. Here's more of the number that we're seeing, and here's why we're seeing it. Here's the comps we're using. So we might have sometimes a tough conversation, saying, hey, here's what we're seeing, and we want to make sure that you understand this is our point of view, this is what we're seeing, and here's all the factors. And then the client has to make their decision as well. But keeping in mind, again, profitability is really, really important to us. So we want 100% for our clients to be successful. So that's why we want to provide that feedback.
Mm-hmm. Right? It's so important. People have to hear that. Now, Donna, do we have some questions that we want to get to?
Yes.
Producer Donna is going to pop us up a few questions here. Unfortunately, Calvert isn't in Newfoundland. Does anybody have any options in Newfoundland that they can share? Well, if anybody does have, they can pop them in the chat. And do you guys happen to have a handy dandy Newfoundland lender you can talk about? Maybe you do. I shouldn't presume that you don't.
Not off the top of my head, but if you just Google private lender or mortgage investment corporation, and just compare obviously apples to apples, main things to look for is just what their fees are. If it's an open or closed mortgage, if there's any prepayment penalties, really understand the fees, administration fees, discharge fees, and just ensuring, you're comparing apples to apples when it comes to rates.
That's important.
Not too sure if there's anything else you'd like to add into that, but if you just get a list of lenders, I know there's probably quite a few out there, but just really digging into the details when it does come to fees and because just they can just add up so much.
Yeah, they can.
Especially if you're flipping, you want to be in and out as quick as possible.
Can definitely be huge.
Mm-hmm.
Next question. Can you please comment on the pros and cons of private lending on one deal compared to a pool of deals and the rate of return on those two investment strategies? So just lending one deal and pool of deals is Calvert. You're
Yeah, for sure.
Deals.
Yeah, definitely one-on-one. You're going to have a higher, you can have a higher interest rate depending on what you lend your capital out for. The only downside to that is it's not diversified. So if things go sideways, if it goes underwater, and you were really banking and expecting to have that capital return to you, you're just obviously not as diversified. With us, you're investing in a pool of mortgages. So we have around plus 700 mortgages out currently right now. So if you invest in us, it's more diversified. We always aim for around the 8 to 10% range. We've been very blessed over the past few years to bat above that average. More than happy to send you our investor brochure emails just down below. And you can see our historical returns, our last quarter, and our year-end financials of last year, and any other relevant information to help you make a better informed decision.
Yeah, and I think back to your loan to value ratio for the whole portfolio. I think you said about 59%. There's going to be the rare one person loan where it's a 59% loan to value ratio. It's going to be going to be a biggie for sure.
Mm-hmm.
When you talk about lowering the risk. Neil Taniguchi, now
he wiped out Sherwin.
Wiped out Sherwin because he has such a big question.
Neil, you're wiping me out already.
Lots of folks bearing on his guys who want to start flipping. What do you see as the number one challenge for first-time flippers who are coming to you without a track record? Is there a way to get a yes and or turn a no into a yes for a first-timer? Sure.
The number one challenge for first-time flippers is finding a good project. I think that's the number one challenge for second time, third time, fifth time flippers. It's finding that project that's going to be profitable. So I'm going to be a little bit negative here and say I don't want to turn a no into a yes unless you're going to be successful on the project. Sometimes we can guide clients to maybe you don't need to do as much as you want to do. Maybe you can do more like a lipstick and makeup kind of reno and get a project to turn from a, maybe non-profitable or not that much to a lot more because it's quicker, turning it that way. So I think that is, for me, always the challenge is finding that project. I think once they do one and they start understanding the turns that any project can take, you can put out any budget you want on a rental plan. I don't know a lot of people that stick to their rental budget very 100% ever. They also don't stick to their timeline 100% ever. So you learn once you experience that first one, that second one, and you can plan for it and you can build it into and be conservative, right? Build it into your overall budget. I think that's one of the biggest challenges too for new people is it's that everything's going to go well. Everything's going to go to plan. And it just doesn't. That's reality, right? Yeah. We know this thing called COVID that happened a few years ago. Nobody could have ever planned for that. That's a crazy outlying event, but outlying events can happen and you never know. And you work with it and you fortunately enough, we had a lot of people that came out of that still perfectly fine, even with a flip project in hand. And then they all dealt with the crazy supply issues that, where you couldn't get certain things. You couldn't get a fridge, a stove, whatever for your new flip. So everybody adjusted. And I think that's the biggest benefit is the ability to adjust to what's going on in the market, what's happening around you, learn as you go and just keep on, moving forward kind of thing.
Well, sure. And I want to emphasize what you've said 2 or 3 times throughout the show today. And that is the best protection really is buying well. Get a smoking good deal on the purchase price. And for that first time guy, if you get that smoking good deal, there's where all your protection is. It's all the protection you get from buying at a very low price that gives you room to make mistakes and room to do all the things that anybody does doing something for the first time. So that, folks, if you're taking something away, buying well is ultra important. And when you're just starting out, you need some advice on what that really means, because buying well means there's going to be you need a much bigger gap than you think you need until you understand how that gap works and how to figure it out yourself. Now, gents, we're coming to the end of the program here. I want to thank Garth Chapman for his comments. Garth is an experienced mortgage broker in his own right, in a kind of a different part of the market, but Garth knows his way around mortgages. So to hear him say that is high praise indeed. So thanks for that, Garth. We're going to finish off with a question from Martina, who says, do you generally deal with principal and interest payments only, or do you do interest only payments from your borrowers?
Go ahead, Dave, if you want to.
Yeah, all of our mortgages, for the most part, are monthly interest-only payments.
Monthly interest only.
Yeah.
Well, that was an easy one to finish off with. Martina, there's your answer. Sherwin, Ryan, thank you very much for showing up and doing this. I personally found this illuminating. I know a lot about this, but I learned a bunch of things today. And for anybody who's listened, if you want to do some private lending, you want to do your own lending, you want to go work with Sherwin and Ryan here, but you want to do your own lending, listen to this program about 3 times to hear what they do to have a successful loan. Private lending has a lot more facets to it than you would think, and you have to figure out what they are and be really careful and diligent about making sure that you go through it and do the things that you have to do to make sure you're going to have a successful loan. Or on the other hand, you can contact Calvert, who will do all that for you, and I think do a pretty darn good job of protecting your money and giving you a great return. So guys, thank you very much for coming on. We'll probably do this again sometime. I'm sure there are going to be lots more questions, and we'll maybe do some deeper diving into some of the other specifics that we could talk all day about this, I know. So Ryan, thank you very much. Nice to meet you. Sherwin, we've talked before, so
Yes.
Great to talk to you again. And we'll catch up with you another time.
Thank you. Enjoy the night, everyone.
Bye, everybody.
Good night, everybody. Good night, everybody.